Hi there, Paul Carson here, Philadelphia Mortgage Brokers. One of the questions I've been getting recently is folks are asking a lot about second mortgages, specifically home equity line of credit, or also known as a HELOC, short for an abbreviation in our world. And I wanted to give kind of a general overview of what are second mortgages, what are your options, what does each one look like, kind of the pros, the cons, and the differences between each. So the example I want to take a look at is a $100,000 second mortgage. So the first option here, if you were to get a 30-year fixed at prime plus 1%. So currently prime is 8.5% on a, let's say for a typical home equity credit line example, for somebody who might have top tier credit, say 760 and above, they could expect an interest rate of prime plus 1%. Now, keep in mind, this is just an example for our purposes now. It's not a specific quote for you individually. If you need that, reach out to us. But anyway, for this purposes, $100,000 home equity line of credit, if it's at prime plus 1%, right now it will be 9.5%. A traditional HELOC works it has a draw period, meaning you can draw on this line for a period of 10 years. If after 10 years, there's still a balance on that credit line, whatever remaining balance is on there converts into a 20-year amortization for you to pay off that balance. That is your traditional 10-year draw period, 20-year amortization, kind of your 30-year credit line. Now, this has an interest-only feature, meaning that during the 10-year draw period, you're only required to pay interest back on the balance that's outstanding. So if there's a zero balance, zero interest, zero payment. Alternatively, you can pay back principal in any fashion you see fit. You could pay it monthly, you could pay it lump sum, you could pay it off the next day after you use the product. With this credit line, the pros are it is very flexible. You can borrow it, pay it off, pay it back down to zero, use it over and over again. It's a financial vehicle. Think of a rinse and repeat. If you use it once, pay it down to zero, it's available for you again. Alternatively, one challenge with the credit line that is variable, it is tied to prime. And in the past two years or so, we've seen prime rise from probably the 4s up into the 8s. So rates tied to prime have also gone up in lockstep as prime has risen. So that is one of the drawbacks to a true credit line. So that's kind of your second mortgage option, known as your HELOC. The second mortgage option we see a lot is a fixed term loan. So instead of getting a credit line that has a variable rate tied to prime and might not have a fixed duration of timeline, we would look at something like you could get a 10-year fix, 15-year fix, 20, 30-year fix. There's lots of different fixed term options for second mortgages. For this example, all I did was took a 30-year fixed rate, same thing, prime plus 1%. So a 30-year fixed, taking the same interest rate on a interest-only payment, it's $791.67. Same amount borrowed, $100,000, but on a 30-year fixed second mortgage would be $840.85 principal and interest. So it's just under about $50 a month difference between the interest-only option and the fully amortizing option versus the true credit line, the HELOC, versus a fixed term loan. Now, there's a third option that has come out in the past year, and it's more of a hybrid. It is a credit line that is available, but you have the ability to, when you take a draw on it, fix your rate and term for that draw. So for example, let's say you had a $100,000 line and you drew $20,000 on it and you kept that as a 30-year fixed with a rate of prime plus 1%. Let's use that for an example. You know that money borrowed on that credit line for that $20,000 draw, you know that payment's going to be for that entire duration. Now, whether you choose to pay that off early and then have that $20,000 available again in your line, you can certainly do that. But alternatively, if you kept that first draw of $20,000 there, you have that other $80,000 part of your line to do future draws. And those other future draws allow you to, same thing, fix in that draw. Let's say it's $10,000 at a 10-year fixed of a different interest rate. Just giving you an example. It doesn't always have to be the maximum length of the term. You can do shorter terms, but this type of hybrid HELOC is an option that allows you to have the benefits of the HELOC and also the benefits of fixing in a draw anytime you go ahead and take a draw on that product. So if you have questions about how second mortgages work, if you have questions about is a HELOC right for you, what are the pros, what are the cons, what is this hybrid option, tell me more about that. We're happy to answer your questions and walk you through the entire process and help you determine what is a good fit for your financial needs, not only today, but short and long term as well. So If you have any questions, reach out to us and our team. You can find us at phillymb.com.